Analyzing businesses feels impossible sometimes. Financial reports are overwhelming. Balance sheets look like a foreign language. And no matter how much research you do, you still end up guessing. Warren Buffett doesn't have this problem. His solution? A 5-step system that cuts straight to the truth about a company's financial health. And you don't need to be a math genius or a billionaire to use it. Buffett keeps it simple, and today I'm going to show you exactly how he does it. I'll break down his famous 5-step system, and in the end, I will apply it to one of the world's biggest companies and see if it checks all these criteria. By the end of the video, you'll have all the tools to analyze any company in a minute. Before diving into the rules, you need to understand the balance sheet. A balance sheet is one of the 3 main financial statements of a business. It's like a snapshot of everything a company owns, owes, and what's left over for shareholders. The equation that keeps it all in balance is total assets equals total liabilities plus shareholders' equity. This means every dollar a company owns or uses is either financed through borrowing, which is liabilities, or investment from shareholders' equity. Buffett loves balance sheets because they show a company's true financial position, how stable it is, how much it relies on debt, and how it effectively reinvests its profits. Rule number 1, more cash than debt. Buffett's first rule is straightforward. A company's total cash and short-term investments, also known as current assets, should exceed its long-term debt. This rule allows Buffett to quickly assess whether a company has the liquidity to survive tough times without taking on more debt. Buffett believes companies with more cash than debt have flexibility and independence. They don't rely on creditors to stay afloat, which reduces financial risk. It's also a sign of a strong business that generates enough cash internally to fund its operations. Businesses with heavy debt might crumble under pressure during economic downturns, but those with more cash are better positioned to thrive. Rule number 2, low debt to equity ratio. The debt-to-equity ratio compares the money a company owes to the money invested by shareholders. Buffett's threshold of below 0.8 ensures the company isn't overly reliant on borrowing to finance its growth. Buffett values stability and self-sufficiency in the companies he invests in. A low-risk debt-to-equity ratio signals that a company is financing its operations primarily through equity rather than risky borrowing. High debt can lead to vulnerability during economic shocks, while low debt reflects financial discipline and sustainable growth. Rule number 3, no preferred stock. Preferred stock is a hybrid between equity and debt. Companies issue preferred stock when they need funding but don't want to take on traditional loans. Buffett avoids businesses with preferred stock, considering it a red flag. Preferred stock often signals financial weakness. Strong companies don't need to issue preferred stock. They can rely on profits or equity financing instead. For Buffett, avoiding preferred stock is a way to filter out companies that may be struggling to raise funds or have poor financial management. Rule number 4, positive retained earnings growth. Retained earnings are the profits a company keeps after paying dividends. Buffett looks for consistent growth in this metric, as it reflects the company's ability to reinvest its earnings effectively. Buffett believes retained earnings growth is a sign of a company's profitability and resilience. Companies that consistently grow retained earnings, even during recessions, show that they can withstand tough economic conditions and reinvest for future success. It's a key indicator of financial health and long-term potential. Rule number 5, presence of treasury stock. Treasury stock refers to shares that a company has repurchased from the market. Buffett likes to see companies buying back their own stock, as it reflects confidence in their value and a commitment to returning capital to shareholders. For Buffett, share buybacks are a way for companies to reward shareholders while signaling that they believe their stock is undervalued. It shows that management is aligned with investors' interests and is using surplus cash in a way that adds value. Buffett's 5 rules may seem simple, but they're incredibly effective because they focus on fundamentals. By analyzing a company's liquidity, debt management, profitability, and shareholder returns, these rules allow you to identify businesses that are built to last. These principles are especially powerful because they prioritize long-term stability over short-term gains. They filter out companies that may look attractive on the surface but lack the financial strength to sustain growth. Now that we've covered the rules, let's dive into why they matter so much. What makes these metrics the ultimate indicators of a company's strength? Buffett's 5 rules of thumb are a proven strategy for identifying companies that are built to last. Each rule serves a specific purpose, working together to highlight the financial health and stability of a business. But why do these metrics matter so much? And what makes them so effective? At the heart of Buffett's strategy is the idea of prioritizing liquidity. Companies with more cash than debt have the flexibility to handle tough times without relying on creditors. Think of it as having a safety net. These businesses can pay their bills, invest in opportunities, and weather economic storms without being weighed down by interest payments. This focus on liquidity ensures that a company isn't just surviving, it's positioned to thrive, even during downturns. Debt is a useful tool, but it comes with risk. That's why Buffett emphasizes a low debt-to-equity ratio. Companies with too much debt are vulnerable to economic shocks and rising interest rates, making them a riskier bet for investors. By focusing on businesses with a ratio below 0.8, Buffett avoids those that are overly reliant on borrowing. A low ratio signals a company that is managing its finances responsibly and funding growth primarily through equity, which is far more sustainable in the long run. Another hallmark of Buffett's approach is avoiding financial red flags, such as preferred stock. Issuing preferred stock is often a sign that a company is struggling to raise funds through traditional means. It's a costly and unconventional way to secure financing, and its presence on a balance sheet suggests weaker financial health. For Buffett, companies that don't need to issue preferred stock demonstrate a solid foundation, signaling that they can rely on their retained earnings or equity instead of resorting to costly alternatives. Speaking of retained earnings, their consistent growth is one of Buffett's favorite indicators. This metric tells the story of a company's profitability and its ability to reinvest in the future. When a company grows its retained earnings, it's not just earning money. It's using those earnings to expand, innovate, and create long-term value. What makes this rule so powerful is its reliability, especially during challenging economic periods. If a company can maintain or grow its retained earnings even in tough times, it's a strong signal that it's built to endure. Lastly, Buffett values companies that align with shareholder interests, and treasury stock is an important part of this equation. When a company repurchases its own shares, it signals confidence in its value and commitment to returning capital to shareholders. While stock buybacks can sometimes be controversial, Buffett views them as a positive sign when done thoughtfully. They demonstrate that management is prioritizing shareholder returns and has confidence in the company's future performance. Now that we've covered Warren Buffett's 5 rules of thumb, let's apply them to a real-world example. For this, I'll analyze Microsoft Corporation with ticker symbol MSFT balance sheet. It's a great case study to see how these principles highlight a company's financial strengths. By following these steps, you'll learn how to evaluate any company's financial health with confidence. Buffett's first rule is straightforward. A company's total cash and short-term investments should exceed its long-term debt. This ensures the company has the liquidity to handle downturns, seize growth opportunities, and avoid over-reliance on borrowing. For Microsoft, this rule is an easy pass. Here's how you can follow these steps for each stock. Search FinChat, then search your ticker symbol. Go to Balance Sheet. For MSFT, the company has $78.4 billion in total cash and short-term investments, compared to $42.9 billion in long-term debt. That's nearly 1.8 times more cash than debt. What does this mean for investors? This means that Microsoft has the flexibility to make strategic decisions, whether it's about funding innovation, pursuing acquisitions, or navigating uncertain economic conditions, without taking on any additional financial strain. Companies with this level of liquidity are less vulnerable to interest rate hikes or economic downturns. Microsoft clearly passes Buffett's rule number 1. The low debt-to-equity ratio is the key indicator of how much a company's funding comes from debt versus shareholders' equity. Buffett prefers businesses with a ratio below 0.8 because it shows they're not over-leveraged and have a stable financial structure. For this, go to Ratios, then click on Financial Health. Here, you will see Debt-to-Equity Ratio. Microsoft's debt-to-equity ratio is an impressive 0.3, well below Buffett's threshold. This means the company relies primarily on equity rather than debt to finance its operations. Why does this matter? A low ratio indicates disciplined financial management and reduces the risks associated with debt repayment during economic downturns. It also reflects the company's ability to sustain growth without accumulating burdensome liabilities. Microsoft also easily passes Buffett's number 2. Companies often issue preferred stocks that need funding but struggle to attract traditional investors. It's a costly form of financing that combines elements of debt and equity, often signaling financial weakness. Buffett avoids companies with preferred stock because it raises red flags about their ability to manage their own finances. Microsoft's balance sheet shows no preferred stock, listed in the equity section, meaning it doesn't offer any preferred shares, aligning perfectly with Buffett standards. This indicates that the company has no need for expensive or unconventional financing. Instead, Microsoft raises capital through retained earnings or common equity, reflecting its strong financial position. The absence of preferred stock isn't just about ticking a box. It's a sign that Microsoft operates from a place of financial strength and independence. Microsoft successfully passes Buffett's rule number 3. Retained earnings represent the profits a company reinvests after paying dividends. Buffett looks for steady growth in retained earnings because it signals both profitability and smart reinvestment strategies. For him, this metric is a key indicator of a company's ability to build long-term value. Microsoft excels here. Its retained earnings have grown steadily over the years, from $34.6 billion in 2020 to $173 billion in 2024, and most recently $188.9 billion in the last 12 months. This consistent upward trend demonstrates that Microsoft not only generates significant profits, but also reinvests those profits to drive future growth. Why is this important? Because retained earnings growth, even during tough economic periods, shows resilience and the company's ability to fund its operations and expansions without relying on external financing. It's a hallmark of a strong, forward-thinking business. Microsoft clearly passes Buffett's rule number 4. Treasury stock refers to shares that a company has repurchased from the market. Share buybacks are often a sign of confidence, signaling that management believes the company's stock is undervalued and wants to return value to shareholders. Interestingly, Microsoft records 0 treasury stock on its balance sheet. While this might seem like a deviation from Buffett's preferences, since he values treasury stock as a signal of shareholder rewards and confidence, Microsoft takes a different but equally effective approach. Instead of relying heavily on buybacks, Microsoft prioritizes shareholder value through consistent dividends and strategic investments. This balanced strategy ensures long-term growth while rewarding investors, aligning with Buffett's preference for disciplined financial management. Additionally, the absence of treasury stock reflects Microsoft's focus on organic growth and operational efficiency, avoiding the risks of artificially inflating performance through excessive buybacks. With this shareholder-focused approach, Microsoft effectively passes Buffett's rule number 5. By applying Buffett's rules, Microsoft checks all the right boxes. Each metric highlights its financial strength, profitability, and resilience, qualities that align perfectly with Buffett's investing philosophy. This analysis also shows how Buffett's simple framework can reveal the bigger picture of a company's long-term potential. Buffett's 5 rules provide a simple framework for evaluating a company's financial health. Start with the balance sheet, publicly available on financial websites, and then look for key figures like cash, debt, and retained earnings. Apply Buffett's rules. Ensure more cash than debt, a low debt-to-equity ratio, no preferred stock, positive retained earnings growth, and responsible use of treasury stock. Pick a company you know, practice these steps. This approach helps you focus on financially strong businesses with long-term potential, giving you the tools to evaluate any company like a pro. Based on these rules, Buffett is buying again in today's inflated market. Want to know which companies he's buying right now? Click the video on the screen to find out.